All right, stop scrolling for a second because something violent just happened in silver and it's still unfolding right now. We're talking about a $20+ move in days, not weeks, not months, days, right after a brutal crash that took silver down to about $71. Now it's trading near 90 in Western markets, while Shanghai is sitting closer to 104. That's a $14 to $15 gap. That's about a 16% premium. And both futures volume and physical desks are flagging the same thing right now. This just flipped from liquidation to squeeze. Stay with me, because I'm going to show you exactly why this matters and how you can spot it next time it happens. Before I explain what caused this move, let me teach you something most people don't understand about crashes. A crash isn't the end of a move. It's often the reset. Think of leverage like dry brush in a forest. When margin hikes hit, like the CME did last week, they force weak hands to dump positions fast. That's the fire. Prices fall. Everyone panics. And it feels like the trend is over. But once that brush is burned away, what's left is a cleaner market with less leverage and fewer forced sellers. That's when real buyers step back in. You're not watching chaos anymore. You're watching structure reassert itself. Now here's why this concept matters so much. Markets don't move in straight lines. They breathe. They contract and expand. When you see a violent flush, your instinct is to think the party's over, right? But that's backwards. The flush is what creates the opportunity. Because leverage cuts both ways. When over-leveraged longs get wiped out, that selling pressure is temporary. It's mechanical. It's not fundamental. The fundamentals, the actual supply and demand for physical metal, those don't disappear just because someone got a margin call. So what you're really watching during a crash is forced liquidation, not genuine price discovery. And once that forced liquidation exhausts itself, the market can actually find its real level again. That's when things get interesting. So what does that tell us? It tells us that crashes create conditions for explosive reversals. Not always, but often enough that you need to understand the pattern. The key is recognizing when the selling is forced versus when it's fundamental. If people are dumping silver because they suddenly don't want it anymore, that's one thing. But if they're dumping it because they literally have to, because their broker is forcing them to close positions, that's completely different. One is a change in sentiment, the other is just mechanics, and mechanics are temporary. If this is making sense, drop a comment below and let me know what you're seeing in the market right now, because I want to know if you're tracking the same pattern. Now let me show you what's actually happening, step by step, because this is where it gets really clear. First, the CME hikes margins. They do this when volatility spikes. It's a risk management move on their end, but what it does is force traders to post more collateral for the same position size. If you're over-leveraged, if you don't have that extra cash sitting around, you have to liquidate. You have no choice. So that triggers forced selling, especially from over-leveraged longs who can't post collateral fast enough. Silver dumps hard, down into the low 70s. Shorts get confident. They press harder. They think they've won. They think the move is dead. Then something changes. The selling pressure starts to exhaust. You see it in volume. You see it in the tape. You start seeing these little pauses where price isn't falling as fast. The velocity slows. And at the same time, physical demand doesn't disappear. This is critical. In fact, Shanghai spot never really broke. It held near 100 and then pushed to around 104. That premium is the tell. It means real metal is getting bid aggressively, even while paper is getting smashed. Western futures are dropping, but Shanghai, where actual physical silver trades hands, is holding strong. That gap is everything, because it shows you the disconnect between forced paper selling and real physical demand. So when futures stop falling and Shanghai stays bid, here's what happens next. Arbitrage desks notice the gap. These are professional traders whose entire job is spotting price differences between markets. When they see silver trading at 75 in New York but 100 in Shanghai, they know they can buy futures, take delivery, ship it to Shanghai, and make a profit. So they start bidding. Physical buyers step in too. Retail stackers, industrial users, people who actually need the metal. Futures start lifting, not because of hype, not because of some social media pump, but because supply at lower prices just isn't there anymore. The sellers are gone. They've been flushed out. Now you've got buyers and no one willing to sell below a certain level. But here's the part that should make you nervous if you're not paying attention. Shorts who got bowled into the crash, who thought they were geniuses for pressing into the decline, they now face rising prices in a market with thinner liquidity. Think about their position. They sold short at 80, maybe at 75, thinking it was going to 50. Now price is back at 85 and climbing. They're underwater, and the liquidity that was there on the way down, all those forced longs dumping, that's gone. So when they try to cover, when they try to buy back their shorts, there's no one selling to them except at higher prices. That's how you get a 25% rebound in just days. It's not magic. It's just supply and demand in a leveraged market. And here's what very few people are talking about right now. These rebounds don't usually stop where people expect. Once 90 is reclaimed, once that level that seemed impossible just 48 hours ago is back in play, the market starts looking for the next magnet. And right now that magnet is 100. Why 100? Because that's where Shanghai is. That's where physical is actually trading. So Western futures have this gravitational pull upward toward parity with Shanghai. As long as that premium exists, as long as Shanghai is willing to pay 104 while New York is at 90, there's pressure for New York to move higher. This is the exact same playbook we've seen before. Go back to 2011. Silver crashed hard that spring. The CME raised margins 5 times in 8 days. 5 times. Everyone declared the bull market dead. The silver bugs were finished. It was over. Then, once the forced selling ended, once all the weak hands had been shaken out, price ripped higher in violent multi-day bursts that overshot consensus. We saw similar moves in 2013 after the April crash. Same pattern. Brutal flush, then explosive rebound. Or look at March 2020. That was wild. Silver got obliterated during the liquidity panic. Everything was getting sold. Stocks, bonds, gold, silver, everything. People needed cash, and they needed it fast. Silver dropped from $18 to $12 in a matter of days. Everyone thought it was done. Then what happened? It doubled. It went from 12 to 28 in just a few months. Faster than almost anyone believed possible. Why? Because once the selling pressure cleared, once the forced liquidation was over, the fundamental demand was still there. Industrial demand, investment demand, and supply hadn't magically increased. So price had to go higher to balance the market again. When you zoom out, the pattern is simple. Flush the leverage, let confidence flip, then let scarcity do the rest. It's happened in copper, it's happened in palladium, it's happened in oil. Anytime you have a highly leveraged market where physical supply is tight, you get these violent whipsaws. Down fast, then up even faster. The larger story here is that these moves feel insane only if you ignore the mechanics underneath them. If you understand that leverage creates volatility, and volatility creates opportunity, then none of this should surprise you. It's textbook. It's just playing out in real time right now with silver. Now, before we go further, I want to show you one more example because it really drives this home. In 2016, we had a similar setup in nickel. Prices had been falling for years. Everyone was bearish. Then Indonesia announced export restrictions. Physical supply tightened. But futures were still pricing in oversupply. The gap between futures and physical spot widened. Sound familiar? Once that gap got wide enough, arbitrage kicked in. Futures lifted, shorts got squeezed, and we saw a 40% move in about 6 weeks. Same mechanics, different metal. The lesson is always the same. When paper and physical diverge, physical wins eventually. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this fail? Absolutely. If 90 doesn't hold, if we see price break back down through that level, then this whole thesis weakens fast. If futures volume dries up, if we stop seeing follow-through buying, that's a red flag. If Shanghai premiums collapse back toward parity, if that gap disappears, then the pressure on Western futures goes away. So yes, this could fail. Any trade can fail. Any thesis can be wrong. And yes, people will always talk about manipulation. They'll say shadowy forces are controlling silver, central banks, big banks. You know the narratives. Could that be true? Maybe. I'm not here to tell you conspiracies don't exist, but here's the thing. It doesn't actually matter whether there's manipulation or not for the purposes of understanding this move. You don't need a conspiracy to explain what we're seeing right now. You just need margin rules. You need leverage. You need supply and demand mismatches. Those are observable. Those are measurable. Focus on what you can control and what you can measure, not the noise. Because even if there is manipulation, even if someone is trying to push price around, they still can't override basic market mechanics forever. Physical demand is physical demand. Arbitrage is arbitrage. These forces are bigger than any single player. Could this be a dead cat bounce? Sure. Could we rally to 95 and then collapse again? Yes. That's why you watch the levels. That's why you wait for confirmation. You don't just blindly assume every rebound is the start of a new bull market. You watch how price behaves at resistance. You watch volume. You watch whether the move is orderly or chaotic. Those details matter. So I'm not sitting here telling you this is a sure thing. There are no sure things. What I'm telling you is that the setup is there. The mechanics make sense. And historically, this pattern has led to significant moves. That's all we can work with. Probabilities, not certainties. There are probably 3 types of people watching this right now. Maybe you're already long silver and you're wondering if this is finally the move you've been waiting for. If that's you, I get it. You've probably been holding for months, maybe years. You've seen silver tease these breakouts before and then fail. You're excited right now because finally, it looks like something real is happening. But here's what you need to hear. Your job is discipline. Watch 90. Watch 95. Don't get emotional just because price is moving fast. Fast moves go both ways. The same volatility that can take you from 70 to 90 can take you from 90 back to 70. So if you're long, great, but have a plan. Know where you're willing to add if this confirms. Know where you're wrong if it breaks down. Don't just ride the euphoria. That's how people give back gains. Or maybe you're on the sidelines, skeptical, thinking you missed it. You saw the crash happen, you didn't buy, and now you're watching this rebound thinking the easy money is gone. If that's you, understand this isn't about chasing. It's about waiting for confirmation. Momentum through 95 with expanding volume. That tells you something different than a dead cat bounce. If we get follow through, if Shanghai stays elevated, if volume continues to support the move, then you're not chasing. You're entering on confirmation. There's a difference. Chasing is buying just because price went up. Confirmation is buying because the structure is validating. So don't beat yourself up for missing the initial bounce. There's almost always another entry if the thesis is correct. And maybe you're a trader who got burned in the crash and you're still shaken. That's normal. You were long at 85. You held through 90. Then it crashed to 70 and stopped you out. Now it's back at 90 and you feel like an idiot. I get that too. But your edge comes back when you stop reacting and start observing structure again. The crash wasn't about you being wrong. It was about leverage and forced selling. That's mechanical. It happens. The question now is whether you can put that behind you and look at the current structure objectively. Can you see that the setup has changed? Can you see that the forced sellers are gone and real buyers are stepping in? If you can, then there's opportunity. If you're still too emotional, then maybe you sit this one out and wait for the next setup. No shame in that. The universal rule for all of you, regardless of where you are, is this. Price is information, not a verdict. Every tick, every candle, every volume bar is giving you information about what's happening in the market. Your job is to collect that information and interpret it. Not to predict the future, not to be right about some big call you made 6 months ago. Just to watch, learn, and adapt. If the information says the structure is bullish, you lean bullish. If it says the structure is breaking down, you adjust. That's how you survive these markets long term. So here's what I want you to answer in the comments. What's your biggest challenge right now with this silver move? Is it knowing when to enter? Is it managing the volatility? Is it fighting the urge to revenge trade after getting stopped out? Let me know, because understanding where you're struggling helps me make better content for you. So here's where I stand. I'm not all in euphoric, and I'm not dismissive either. I'm engaged. I'm watching. I'm analyzing. First, I'm watching 90 as support. If that holds, if we see dips back to 90 but buyers step in and defend it, the market is saying something. It's saying that 90 is fair value right now and there's demand below it. That's constructive. Second, I'm watching 95 as the momentum trigger. That's where shorts start feeling real pain. That's where the people who sold into this rebound start questioning their thesis. If we get through 95 with volume, with conviction, not just a quick spike, but a sustained break, then I think we're going to 100. Third, I'm watching Shanghai. As long as it stays above 100, as long as that premium persists, Western prices are under upward pressure. The arbitrage forces don't go away just because we want them to. They're structural. Based on my analysis, this crash wasn't random, it was mechanical. The fundamentals didn't break, they're actually validating. Think about it. Physical demand stayed strong. Shanghai didn't crack. Industrial users are still buying. Retail stackers are still accumulating. None of that changed during the crash. What changed was leverage. And leverage is temporary. It comes and goes. So now that the leverage has been flushed, we're back to fundamentals. And the fundamentals say supply is tight and demand is real. If history rhymes, and if silver can hold above 90 and push through 95, the move that follows could surprise a lot of people. I'm not making a price prediction. I'm not telling you we're going to 120 or 150. I don't know. Nobody knows. But I do know that when you have tight physical supply, strong demand, a short squeeze in futures, and a premium in the cash market, those conditions create explosive moves. We've seen it before. We're seeing the setup again right now. I'm not a financial advisor. This is not financial advice. I'm just a guy who watches markets, who studies patterns, who tries to understand the mechanics underneath the price action. Everything I've shared with you today is my interpretation of the data. You need to do your own research. You need to make your own decisions. You need to understand your own risk tolerance. Don't take my word for anything. Verify it yourself. Look at the charts. Look at the volume. Look at the Shanghai premiums. See if you come to the same conclusions I have. Or don't. Maybe you see something I'm missing. That's fine too. But if you made it this far, you're the type of person who wants to understand markets deeply, not just trade on headlines. And that mentality will serve you well, not just in silver, but in every market you touch. Because the principles are the same everywhere. Understand leverage, understand supply and demand, understand the difference between mechanical moves and fundamental moves. Master those concepts and you'll be ahead of 90% of people out there. If you found value in this breakdown, do me a favor and share it with someone who's trying to make sense of what's happening right now. Hit that subscribe button if you want more real-time analysis like this. And drop a comment with your thoughts, your questions, your own observations. I read every single one. We're building a community here of people who think critically about markets, and I want you to be part of that. Stay sharp out there. Verify the data, think critically, make your own decisions, and I'll see you in the next one.